One of the most important benefits of tokenization is democratization of investment. Inspired by this notion, many of our clients rush to exclude any institutional investors from their target audience. But democratization is not about excluding large investors. It's about including small ones. The pragmatic reality is that professional investors matter. They invest much larger sums, provide professional support, and enhance your reputation. For many fundraising campaigns, this is crucial, so you need to learn how to approach institutions. In this video, I explain the types of institutional investors, their preferences, how to pick the right ones for your offering, and how should you target them. So stay until the end to understand how you can power up your fundraising campaign by reaching out not only to the retail crowd, but also to investment institutions. My friends, welcome to Stobox Insights, a video series about innovations in capital raising and finance, brought to you by an award-winning consulting and technology company. We have worked with dozens of clients, raising from less than $1 million to hundreds of millions of dollars, spanning 5 continents and 8 industries. On this channel, we share our hard-earned experience and research completely for free. So I highly encourage you to subscribe, turn on notifications, and explore other videos on this channel. Firstly, let's understand the 3 ways in which institutional investors create value. First of all, the average paycheck of an institutional investor is orders of magnitude bigger than the individuals. Retail investors usually invest from a few hundred to a few $1,000s. High net worth individuals invest from $10,000 to $100,000. Institutional checks start at $100,000 and go into tens of millions. If you aim to raise over $10 billion, targeting them is essential to closing the round. For example, if your target is $50 million, relying on $1,000 contributions requires 50,000 investors. This is problematic because marketing channels have diminishing returns, which basically means that starting at some point, getting each new investor becomes increasingly more expensive. Secondly, professional investors offer valuable experience and connections, such as board members who went through similar challenges. Moreover, having whales on board improves your reputation, which can actually make you more attractive to smaller investors too, by providing social proof. Thirdly, institutions usually have a longer planning horizon than individuals. Consequently, they are more accepting of long-term strategies that don't pay back cash for a long time. This is especially important if you have a high return on capital, which makes it much more beneficial for the company to reinvest earnings instead of distributing them. However, by creating liquidity, tokenization makes this characteristic less important. If reinvesting grows your share price, and investors can actually see this thanks to the active market, they will more likely accept the lack of dividends. Moreover, short-termist investors get the possibility to exit when they want, instead of pressuring you to pay dividends or even to sell the company. If you would like to learn more about how tokenization creates liquidity, watch our video on that matter. There are many ways to classify institutional investors. The one we offer isn't all-encompassing or mutually exclusive, but includes the most typically used classes. The first is mutual funds. This is the most widespread fund type favored by non-accredited investors. You can invest in it or exit at any time, which requires mutual funds to work solely with highly liquid assets, such as public equities or public bonds. For most STOs, receiving funding from mutual funds will be complicated. Still, it's possible if your valuation is high enough and can create sufficient liquidity. The second type is private equity funds. Although they invest in privately held enterprises, they are an unlikely investor in STO. The reason is that PE funds prefer acquiring the whole company, changing the management team, and doing the overall turnaround. Consequently, Private equity funds will be interested in STO only as a way of syndication, that is, raising additional capital from broad investors to fund the acquisition, with the fund manager remaining a general partner with a controlling stake. Engaging private equity funds as an investor is feasible if you mean to sell the company. We have a video explaining how to sell a company via tokenization, which you can review to dive deeper into the topic. The third type of institutional backers is venture funds. Primarily, they invest in startups with a potential of 100-fold, even 1,000-fold growth. Although most of our clients are linear businesses, if you're a startup with such growth potentials, VCs can be your best investors. In this case, tokenization will help you create liquidity earlier in your life cycle, providing investors with more flexibility to exit. However, you have to be careful while working with VCs, as they tend to push companies hard to achieve lightning-fast growth, which can be very unsustainable. We have another video that explores this subject in greater detail, which I encourage you to check out. The fourth type is family offices. These are private funds created by wealthy families to manage their assets, grow them in value, and sustain the family members' lifestyle. Family offices are a very diverse investor class, so you can find family offices investing in almost any asset class. Thanks to this flexibility, family offices are an ideal investor for STOs. Most such investors are quite conservative, so working with them will be simpler if an underlying business has less risk. However, some family offices may have a higher risk appetite and will gladly allocate part of their portfolio to risky ventures. The biggest funds are sovereign wealth funds. This is where the countries place their income from selling oil, gas, and other natural resources. As they possess enormous capital, these funds consequently invest in large undertakings, so you should approach them only with an investment request in billions. You would also have to consider the fund's strategy, in particular whether they invest domestically or overseas. The sixth and the last type is pension funds. Like the previous one, pension funds prefer investing in big projects as they possess significant capital. However, liquidity is less necessary for them compared to mutual funds. As people investing in pension funds have a long-term perspective on that, pension funds can afford to work with private placements. There are several factors you should take into account to understand which investor type is the best fit for your offering. The first and foremost thing to consider is the size of the round. A round of $1 million may be easier to close with retail investors, while a $100 million round will be impossible to finish without institutions. Secondly, think about the desired level of liquidity. It will determine whether you can raise capital from mutual funds and other investors who value liquidity. One of the primary advantages of tokenization is actually increasing the tradability of private assets. You can learn more about how it works in a video about decentralized trading. Thirdly, consider the industry of your offering. Institutional investors often specialize in a specific industry and region. It's much easier to get replies from entities already interested in companies like yours. Lastly, think about your risk-return ratio. It determines whether you should reach out to more or less risk-averse investors, as well as the positioning of your offering: stable safe haven or a high-return gamble. There are two main ways you can get in touch with institutional investors. Firstly, you can often find lists of institutions by industry and geography online. Sometimes it's enough to search on Google or LinkedIn, while in other cases you should buy the list of family offices or use other platforms like Crunchbase or AngelList. The second common approach is to visit the events tailored to investing in a specific industry. Although travel expenses and entry tickets increase the cost of fundraising, getting feedback is much faster in face-to-face interactions. But it's not enough to get in front of investors. You need to present a compelling offer. Security token offering is an excellent instrument for making institutional investors even more interested in working with you, and they have an interest in doing anything enhancing their liquidity, or returns. But at the same time, they conduct a much more qualified due diligence than retail investors. This is why properly structuring your offering is vital. For this, it's advisable to use the services of a consulting company like Stobox, whose specialists can advise you on improving your business plan, legal structure, capital structure, and other factors. To verify whether we are the right fit, feel free to book a complimentary 30-minute consultation with our team by filling out the form on our website stobox.io or writing us at info@stobox.io. Stay tuned and see you in the next episode.